The way you have to look at bonds is you look at the credit quality, you look at the duration, you look at your yield, what are your risks? We're at Treasury rates, intermediate and long intermediate Treasury rates that we haven't seen since 1949 during this period of the Treasury Fed Accord. We're basically at the lowest rate levels in the history of this republic. You have to think, given the zero bound of the Fed policy, that we're closed. The skew of risks are heavily weighted toward the upside in yields. So what I care about is, where is the trap door? And if you look at a chart of 30-year Treasury yields, going back to the peak in 30-year bonds at, I think we had the 14s of 2011. So 1981 was when we had roughly 14% 30-year bond yields. Over the last 25 years, bonds have been in a beautifully defined bull channel. The top of that channel comes in right around 4.45%. So it's a bull market until the bull trends break. And that's my stop-out level. So you have to be willing to take punishment, as Lee described before, duration punishment, if you're in long-duration assets, up to that level. If we break that level, I think that's game over for this long-term bull move, and the investment that will give you the highest return in treasuries is buying 3-month bills and rolling them over every 3 months.
Right, right.
That's it. That was the traditional trade of the late 70s and the early part of the 1980s to try to make returns, and it was one of the top-performing assets back then.
But if we break that level,
that'll be a sign.
How quickly does it unwind?
Who knows? It just tells you that the 2.5% low in 30-year bonds on December 18th of 2008 was the low of probably the rest of your life.
But we have to see some GDP growth to justify that, no?
Oh yeah, and you'll have plenty of warnings. And the other thing I'm going to be looking for is the canary of the coal mine, are when centrists on the Board of Governors, like I would say Tarullo or Lockhart of Atlanta or Bullard of St. Louis, start to shift toward the hawkish side. When Ben Bernanke or whoever is the chairman at the time starts to lose his majority, and the majority swings to the hawkish side, then you know that what's more likely to come from the Fed are reverse repos, asset sales out of the SOMA portfolio, and higher Fed funds.